let's look at what the world wants from India. We are inviting someone who has been looking at India for a long time and invested here. Geoffrey Dennis of UBS is joining us now. Well, Jeff, we have been in pre-budget mode for a bit now. So let me start off straight away with that question. For you, what will qualify as a good budget?
Well, what we'd like to see is some sign of fiscal consolidation. We'd like to see a budget deficit of forecast of somewhere around 3.5% to 4% of GDP. That's very important to see ongoing progress to reduce the budget deficit. We'd like also to see a clear roadmap on structural reform going forward, obviously focusing on, in particular, the fiscal side. So we'd like to see more evidence of reductions in subsidies, for example. And we fully expect to see some pretty significant increases announced in infrastructure spending. So I think that's the sort of mix of things that we would like to see, because if you get that sort of announcement, I think that can pave the way for further interest rate cuts down the road.
Okay. The street is fairly deeply divided, with those who are fixated on fiscal deficit remaining at that given 3.6% mark for next year, and others who believe that the finance minister can take liberties provided it is spent on infrastructure. Would you be terribly upset if 3.6 is not adhered to?
I don't believe so. Our forecast is we assume that the budget and the economy will translate into a formal forecast of 3.9% of GDP. So we are at the top end of that range. I think what's important for the markets, and it's certainly important for foreign investors, is to know that the trajectory of the deficit is coming down. And so while we would like to see growth of, a deficit of 3.5% of GDP for fiscal 16, I think as long as it's lower than 4%, I think the markets will probably be okay with that.
Okay. Jeff, valuations have risen. Will you buy India if this budget pleases?
Yes, we certainly do. Valuations are high. We reckon India's trading on about 17.5 times forward earnings. But we think valuation should be high for a couple of reasons, related reasons. One is earnings growth is good. We're expecting earnings growth to be around 15 to 16% in dollar terms over the next 2 years, which I think will support these high valuations. So if you do an old-fashioned PE to growth ratio, India 17 times, earnings growth 15 to 16%. I think it's perfectly acceptable in a world where you are clearly seeing you're clearly seeing earnings growth being a challenge for a lot of emerging market countries. And then the other point that we think is important is that corporate sector performance is very strong in India generally. The rate of return on equity is very high. And so that also justifies high valuation. So we think you'll see some more upside as long as the budget's okay. And we remain overweight.
All right, so remain overweight on the Indian market. So you're even going into this budget overweight. So which are the areas that you're positive on now?
No, we would definitely go into the budget overweight. And in other words, we've been overweight for a while. We wouldn't change that just because you're heading into the budget. The areas of the market that we like some of the energy names, in particular, because they tend to be broad energy conglomerates to a certain extent. We like some of the banks. We actually believe you're seeing some reform within the state banking sector, which is worth highlighting. We like some of the industrials. We like some of the consumer stocks as well. I don't want to talk specific names, but those are the kinds of themes that we're looking at as a way to play an Indian overweight at this point. And also, I guess, that perhaps a little bit of technology also.
Well, since you mentioned banks a couple of times, the public sector banks have actually announced higher loan defaults or bad loans. Will you still buy them?
Yeah, we think so, because we just don't think this is going to be driven particularly by these short-term factors such as deteriorating, a near-term deterioration in the quality of the balance sheet. We think that the growth of the economy, the growth of the economy and the drop in interest rates over time should ensure that we don't see a significant deterioration of the balance sheets of banks. The ROEs are quite good in the banking sector, and I think as you start to liberalize the state-owned enterprises within the financial sector, I think you'll see some relatively good performance. So, yeah, we're trying not to focus too much on the short term. It's a sector that we like for the long term, and I think that this is one way to play the market at this point in time.
Oh, yes, the long-term corporate governance improvements is what everyone's waiting for in public sector banks. But anyway, to come to the broader theme, are you an investor in Indian fixed income as well? And does that look attractive now?
We're not particularly focusing directly on fixed income. I don't focus on fixed income, but I think one of the things that we've not talked about, which is very important in India, is that we think we're going to see another 100 basis point drop in interest rates over the rest of this year. That is, of course, partly because of the robust performance, the robust stance of monetary policy when the new central bank president came into office. At the same time, you're getting lower oil prices, which is adding a little bit of icing on the cake, if you like, of the lower inflation story. And so if that plays out, lower inflation, lower interest rates, fixed income will probably continue to do well. But whereas in other markets where you've got good opportunities in fixed income and you've got concerns about growth, which could impact equities, we're pretty bullish about the growth story in India also. And that means that lower yields and lower interest rates will simply support a higher equity valuations and therefore a further gain in the equity market.
So as the rate cuts pan out, will you change your sectoral exposure?
No, well, we have to talk about where we're positioned now, and where we're positioned now is as I've gone through. Clearly, if you do see a further significant drop in interest rates over time, you might see some of the more interest-sensitive names doing better. But at this point, we'd rather refer to where our overweights and underweights are. But lower rates will benefit the overall economy in our view, and they are positive for the market overall.
Let's discuss crude now, because, you know, we've seen a resurgence of crude, but can India bank on crude remaining low? I mean, what's UBS's worldview on crude now?
We think it is something India can bank on, taking the year as a whole. We expect oil prices, Brent prices, to average $52.50 this year. Oil just this morning over here in the U.S. has just fallen below $60 once again. So you've seen this huge decline. You've seen largely a technical bounce in our view. And now I think oil prices are probably going to settle in the low 50s as opposed to rebounding sharply higher again. And so I think you can rely on that. They are a real benefit to India. India is one of the biggest beneficiaries of lower oil prices. They will help real income growth. They'll push inflation down. They will therefore create more room for the central bank, arguably, to reduce interest rates. And they ought to help corporate earnings growth for those companies that are energy intensive. So, yeah, we think oil is going to settle out at half the level it was in the middle of last year. And that's going to be a long-term benefit for the India story.
Geoffrey Dennis, thank you very much for joining us with your views on those range of issues and sectors that confront India.